Welcome back. Now, you'd remember the chatter from Monday when the RBI issued an advisory. So, over Monday and Tuesday, there was some pressure on the gold financing stocks because the advisory didn't point out fingers towards anybody, but it did say that there are a lot of internal issues, especially where banking correspondents are involved or third-party service providers are involved, where perhaps proper due diligence is not being done. The RBI raised issues like when gold auctioning happens, whether all the norms are being followed or not, whether the end use of gold loans, whether that's being properly monitored or not. So it, in general, was advising for more caution and higher due diligence. Well, we have to discuss that and a lot more with our next guest. We have with us Pranav Gundlapalle, Senior Analyst, India Financials at Bernstein. Pranav, thank you for taking this call. So let's start right there. What did you make of the advisory? It wasn't penalizing in nature at all for anybody. But it was pointing out to a lot of potential discrepancies which are there in the system, a little unusual. What's your stance on the listed gold financing plays right now?
Right. See, I think it was in line with the series of actions that RBI has been taking on the consumer side. So given that the gold loans have seen a significant increase, was not a big surprise. But I think on the positive side, the lack of any specific changes to the product, credit risk weight or something of that sort, was probably a sign of relief, number one. And number two, given that they had a long list of observations and have left it open for the lenders to go and fix it over the next 3 months, suggests that either A, we have this as a more widespread issue, and two, is something that they would prefer the lenders to solve themselves, not something that can be solved by extra regulations or extra risk weights or interest rate caps and stuff like
that. Got that. So, Pranav, just a quick, should we differentiate between companies which have been in the gold finance business for a long time, like Muthoot and Manappuram, right? And companies and banks who have gotten into the segment because it's such a fast-growing area. Because I remember even at the time when that, the IIFL ban happened and then they clarified that you can only disburse so much in cash, right? There were conversations that, companies which only do this or have done this for a long time, I mean, there are set processes and the regulator also kind of understands how this has been happening, etc. But from some of the is this more directed towards some of the newer players who've come in that sense?
Definitely.
Yeah.
In fact, we actually think this set of regulations are positive for those who've been doing this for a long time, like Muthoot or Manappuram. Because if you look at the list of observations, those almost seem like 101 stuff that most of the gold lenders would have solved by now. And they've survived 2 decades of RBI audits. So I'd be very surprised if there is a slip up from the monoline gold lenders on some of these areas, right? And also, given that they don't have the hassle of doing agri gold lending, which is what a lot of banks focus on, I think the whole end purpose monitoring and agri documentation, etc., would also be less onerous on them. So, I see this as like you said, a greater change for banks and also other fintechs or NBFCs that have entered into the segment, especially in the context of a slowdown in unsecured lending. So there is a general shift towards more secured lending. So this is more a preemptive move from RBI to say, let's kind of tighten this before we see a flurry of new players coming.
Pranav, thank you for waiting. Just a quick word. So what are your sort of top ideas from your coverage universe, Pranav?
Yeah, so I think amongst the larger banks, we like HDFC and Axis at this point. And we are not too bullish on the consumer lenders. We still think that there is some more downside on the asset quality. We are probably a few quarters away from what I would call the bottom of the consumer cycle. So we like the larger banks, and amongst them HDFC and Axis. Amongst the NBFCs, we like the gold loan lenders. We like Muthoot a lot. I think at this point, while there is a tailwind of a rate cut, we would stick with the secured lenders, which is the likes of Muthoot.
Mm-hmm. So, Pranav, if I could request you for a sneak peek into the season that's about to kickstart. I think one issue that everyone's going to watch out for is credit cost and any deterioration in credit quality with all this conversation around microfinance and unsecured, right? So from that perspective, if you could single out entities that may be worse off. So we need to just watch for those managements, the commentary and the numbers as well. And from the margin perspective, because that's another debate, what's happening to margins considering the rate environment that we're in? What should we watch out for? And which are the entities that could perhaps preserve margins and which are the ones that could see the maximum stress?
Right. See, I think on the asset quality front, it's all the ones with the exposure to microfinance. So the pure play microfinance lenders, we've got quite a few of them that are listed. So they will be the ones to watch out for. In terms of the larger banks, I think microfinance will be an important consideration for the likes of IndusInd, where I think the stock has most of the things going for it, except that they need to know where the bottom is in terms of the microfinance credit cost. So that's on the credit cost front. And in terms of the NBFC space, the consumer lenders, SBI cards, Bajaj Finance would be the ones where the credit costs would be the main thing to watch out for. We've seen some deterioration in the last quarter, a prolonged one for SBI cards. A continuation of that would be a negative, especially given the run-up in the last month or so, where there seems to be some assumption of bottoming out of credit costs. If that does not hold true, then we could see significant downside. So consumer lenders on the NBFC front and on the bank side, IndusInd is the one more exposed to the microfinance side. Now, on the margin side, I think we are starting to see some improvement in liquidity, which I think is a positive. So which means that we are probably at the bottom in terms of the margin pressures. Right? So I think this quarter would probably be the one with the last piece of deposit pricing increases. And the ones with fixed rate books will start getting better position as we move into easier liquidity and potentially rate cuts as well. Again, IndusInd stands out there as the one with a greater share of fixed rate book and therefore could benefit from rate cuts. And HDFC, while its loan book is not too different from the others, could see their liability costs move down with rate cuts. So they again will stand to benefit. So amongst the larger banks, with margin pressure almost coming to an end, us looking forward to rate cuts. I think IndusInd and HDFC do stand out as our topics from a margin perspective.
Got it.
Yeah.
Got it. Little short on time, but this is very, very helpful. Pranav, thanks for joining in. And we promise to get you back once the numbers start rolling in. It'll be helpful analysis. You have a good day. Thank you very much for being with us on the call this morning.